the mid caps, it often indicates some sign of euphoria. So we can see somehow that the history has been forgotten in that sense. And perhaps it is not surprising that given the number of new participants who have come in both stock market and the mutual fund side, uh, the history is clearly have been forgotten. So I'm getting messages from various investors seeking recommendation for various mid and small cap stocks. So that clearly suggests that people are looking for like quick money in these kind of stocks. So let us dive into some of the statistics. So we are saying that the small cap index uh, has been has been had a bad history of biggest drawdowns in the past. So if you see how the brutal the bear market rallies in these small caps can be, if you see the Nifty small cap index have fallen over 78% from its January 2008 peak over the subsequent 14 months. So if you see the fall has started from 8th Jan 2008, and the fall had bottomed out in March 2009. And the bear market in the small cap index has that time got over by 2016. So that was roughly a good 8 years, and the drawdown small cap index we have seen was 77%. So even the small cap bull market, which was started in 2016 to 2017, it did not last very longer. There was another 65% fall that you can see from January 2018 high, and that lasted for over 14 months. And the end of the bear market took about 1200 days, and the fall was 65%. The level was crossed again only after 3.5 years later in January 2021. So these were some of the biggest drawdowns that we have seen in the small cap indices. And if you see that the annual volatility of the small cap index since March 2020 has been about 24% annual volatility. And the most brutal bear market that we saw was about 8 years. So the small cap euphoria, if you are checking it out, uh, there's a very common comment, from the investors that the markets could fall, but my small cap portfolio has, only quality stocks which I've handpicked, so my stocks will not fall. So there are some statistics once again which I would like to point out. So in 2008 and 2009 crash, small cap stocks which did not fall were just about 1% of the overall basket, and 90% stocks were down by more than 50%. So that's a very alarming figure that we are seeing. Secondly, in the 2018 to 2020 fall, 78% of the stocks were down by more than 50%. So again, the history is repeating in that sense. And lastly, the main bit, the small cap index changes after every 5 to 6 years. So if you see, small cap index has seen a change of 18 to 20% of its constituents every year in most of the years. So the churn is very high, if you can see. So in about 5 to 6 years, the index changes almost completely. It is altogether a new index. So if you feel that you will wait for like 5-6 years for your stocks to recover, the hard reality is that in the past many have never recovered, and some stocks have vanished, and while some have turned into penny stocks. So in that sense, buy and hold in some of the small cap names which are not well researched, or which are not picked out after careful analysis, the chances are high that you could not survive. These stocks will not survive the small cap cyclical correction that it sees every time. So, how to play the small cap stocks now? So, since uh, um, we see that the small caps are like very easy to enter, and but it is difficult to exit. So easy to enter in the sense that we have ample liquidity when the stocks are going up, and it's easy to buy. We get tips from everywhere, so it's easy to enter that ways. But the exit is what which is very difficult in these stocks, because most of the times the operator are the first one to leave the ship when it is sinking, and that ways we see for some of the small cap stocks going into lower circuits every day. So that's where these small cap stocks are difficult to get out when the tide turns around. And generally, the small cap rally is the risky end of the market. So the key here is not let the FOMO affect you. And as a rule, one should not allocate more than 20% of the portfolio in small cap stocks. More than 20%. So if you follow these things in the asset allocation space, not allocate more than 20% at any given point of time, and tilt the portfolio more to the large cap space, should be able to. So this is an interesting chart that I wanted to show. It is the spread of Nifty 50 index and with the small cap index. So we see that the spread of Nifty small cap 100 index and Nifty 50 indexed, the chart which I've plotted, it's the spread basically. So that suggests that small cap stocks are prone to a major decline in the coming days. We see that it's touched the upward channel, and this particular chart is projecting that we could see a dip. So on the market scenario wise, if I tell, there are a few triggers which I had mentioned last time, which is the US Fed pivot timing, then the global liquidity tightening, the high US yields, the election of 2024, and high energy prices. So if you see the valuation of the stocks, the markets in general, the Nifty PE is near about the average line. It's around 18.6 or so, which is average, not very overvalued, but yeah, near the average. But the mid and the small cap space, it's slightly above the average for the mid cap, which is 26 times. And for small caps, it is 18 times, which is above the average of 15, which small cap has seen historically. Pivot timing we discussed last time. So a Fed pivot is when a Federal Reserve reverses its existing monetary policy stance. Last Fed pivot that we saw was when Fed began rising interest rates in March 2022, which started with a 25 bips rate hike, and the Fed shifted from a loose monetary policy to a tight monetary policy. So rates now stand at 5.25%, 5.25 to 5.5%. Report, which means that the Fed will cut rates this time around, was earlier expected by mid 2023. So after the recent Fed policy, the expectation now are that the Fed will not pivot until mid 2024. So in that sense, the market expectations that the Fed will start cutting rates from this year has shifted by 1 year. So if you check the yield curve, the yield curve is inverted. That is, the 2-year yield is more than the US 10-year yield. And most of the global crisis we have seen in the past is activated post the inverted yield. So US 10-year yield climbed recently to highest level since 2007 as Fed has signaled rate hikes in future too. So the US 2-year yield has approached 2006 highs, as you can see, and the yield curve is most inverted since 1929 and 1979. So this chart is definitely pointing to something. And if you can see in the US markets, this chart shows the Nasdaq in white and the US Treasury, 10-year Treasury in red. So there's some disconnect in this chart. If you can see, in the past, we've seen that the stock markets and the Treasury yields have been going in tandem. But this time around, this year, we are seeing that the stock markets are rising and the treasuries are falling. So disconnect here, and it is expected that this disconnect correct itself, and the Nasdaq could fall to match the 10-year treasury yields, not yields, the treasury prices. So that disconnect could correct over the coming days. Oil prices are, back below 85 a barrel now, after it touched a high of 97. Crude oil price have fallen by 12% this week after, a brief rally of 97 a barrel. There is change in the output policy. The fall of 12% is in spite that the OPEC Plus has come out with no output in the policy. The Saudis and Russia have reaffirmed that their cuts will come through the year end. So, in spite of these two, the crude prices have fallen in this week. The main reason could be the US gasoline inventories, which increased by almost 6.5 over a week, the largest increase since January 2022. So we maintain a bullish view on crude oil prices, and we see the crude prices to cross 100 over the coming days. So Indian rupee, we are saying that it's broken the key support of 83, and it's reached the all-time high. and we're expecting rupee to touch about 87. So that's a view on rupee. USD INR, we are expecting to cross above 85 to about 87. On the Q2 results side, the IT sector will be posting their numbers anytime now, and it's the result season time. So briefly on the IT space, I would like to cover. The Q2 in the IT sector is seasonally a strong quarter. However, the current macro conditions are expected to impact the revenue growth of IT companies. The IT companies are seeing strong deal wins led by cost takeout deals. The ACVs are still lower due to long tenure deals and the pricing and transition effect. We are seeing slowdown in discretionary spend, and new short-term projects is hampering growth. In the large caps space, we are seeing dollar revenue. We are expecting the dollar revenue to growth in the range of minus 0.5 to 3.5%, and a negligible cross currency impact. Among the mid cap space, we expect minus 0.1% to plus 2% QOQ growth. So while Accenture recently posted a soft quarter in its managed services deal bookings, which is indicative of extended weakness, the booking volatility has been stronger in Indian IT. The deal bookings in the sector have been robust, with several mega deals centering around cost optimization and consolidation. So there are various key large deals in the quarter by Indian ITs. First is the JLR Georgia DOL deal by TCS. Then there is Liberty Global Dansec deal by Infosys, and a deal by HCL Tech. And we're seeing that AI spending and adoption are expected to accelerate and supplement the growth, even as cloud migration, application modernization will be large, medium-term spend imperatives. So in the IT space, I would say that we remain bullish that weighs on TCS in the large caps. Coming to the RBI policy front, we're seeing that today the RBI policy came out, and the repo rate was kept unchanged at 6.5%. The RBI was focused on withdrawal of accommodation. The FY24 GDP growth is projected at 6.5%. The RBI has retained inflation projection at 5.4%, and the real GDP growth in Q1 FY25 is seen at 6.6%. See, the overall CPI outlook is clouded by outlook on key crops. So the unchanged repo rate somehow is a festive bonanza for home buyers, and it gives them another opportunity to make cost optimized home purchases. If we consider the present trends, the overall consumer market looks quite bullish across various sectors, particularly the automobile and housing market. We are entering the festive quarter with good momentum in housing sales, and with the unchanged interest rate scenario, this will act as a catalyst for growth in the residential market. So I would suggest that one should be on the market outlook front. I would suggest that one needs to be rational over emotional. I would reiterate that. I would suggest taking profits in rising market wherever the profits are more than expected, and if you feel that the profits are valuations don't justify the rally in the stock prices, would suggest that you take profits in the rising market. Which suggests that to clean your portfolio in the rally, if your portfolio size is more than 25 or 30, it is the time to prune your portfolio and bring it down to again 25 or so. Would suggest to shift to large cap lagats, in the sense that there are many large cap stocks which have not participated in the rally. An example of that will be HDFC Bank, Britannia. So shift to large caps which have quality growth, and hedge in some way the volatility risk that we are foreseeing. So that is all from the presentation side. We can open the Q&A. If you have any questions, you can post. So a question that one start investing in Quant small cap and Nippon small cap? So the answer to this is don't invest in lump sum. SIPs are anyways safe, but yes, don't get carried away by the euphoria in small caps, and do in SIPs. So if someone is investing only in small caps, a question is appearing that if someone is investing only in small caps, 100% of a portfolio in small caps, it's not advisable. As I said, 20%, not more than 20% of your portfolio should have small cap stocks. So yes, you are taking too much risk by investing only in small caps. So SIP in small caps, yes, one can start. No issue in that. So there's a question that any impact on the election that we see in the market. So I would not get into politics here, but the various views from the political analyst, if you see, uh, the expectations are that the Prime Minister Modi could have a bit of tough time in this election. So markets will start factoring in the election expectations, and volatility will be very high pre-election. That has been always a case in the past too. So investing in PMS a right time. So lump sum investments could be minimum at this point. Again, I would say staggered investment approach will be ideal at these times. One can start via SIP or phase out their investments over the next 6 months. So for large cap stocks, I like specifically HDFC Bank after the recent correction. TCS is another pick. Britannia, one can pick, and Ultratech. So question here is, what should one prefer, mid cap or flexi cap? Multi cap or flexi cap? So both those schemes have their benefits, but personally, if you ask me, flexi cap is something I would prefer because the fund manager has enough information and market data to decide when to shift the cap weightage from mid to small or mid to large. So flexi cap or multi cap would serve that purpose, but flexi cap would be better here. So outlook on somebody's asking. So I feel RIL would underperform for an extended time because the main purpose for taking the RIL stock higher was the geo listing. So now that the geo listing is out of the way, I feel RIL will underperform for an extended time. So if someone is planning an SIP in Nifty 50, mid cap 100 and small cap 250, you could start the SIP for long term, and but maintain the ratio of more than 50% in large caps, 25 or 30% in mid cap, and 20% and lesser in small cap. So if somebody is planning an SIP for a longer duration of say 5 years or more, you can continue the SIP. Don't worry about the near-term volatility, since your SIP investments will average out in for a longer if your holding period is longer term. But yes, I would also suggest that keep some lump sum cash or lump sum funds handy in case we see sharp volatility and a sharp downturn in market. So SIP investments, one should not tinker around. Continue your SIPs. So there are no further questions. We can conclude this webinar. Thanks for joining the webinar. We will be having such webinars once every month, which is the first Friday of every month. Hope to see you next month for the next session of the webinar. Thank you so much for joining.